Hey everyone, it's Mike Bond with Smart with Debt. Today we're going to go over what is a HELOC. A HELOC is a great product, especially if you're looking to lower your debt, pay less for what you have out there. As long as you take care of it, understand it, make sure you understand all the pluses, the minuses of a HELOC. I've noticed after 30 plus years of being in the mortgage real estate investing world, working with HELOCs, even with people who work with them all the time, it's somewhat confusing, it's somewhat a mystery to people. So I just wanted to run through what is a HELOC, how it can help you lower the cost of debt. Remember, our whole point here is to lower your cost of debt, to get you into better debt. But sometimes a HELOC is better debt. Most of the time it is, as long as you manage it, take care of it responsibly, and not make it a burden. It is something that you can take credit cards and divide it by 3, what you're paying for them. So if you have $10,000 paying like $2,400 a year in debt or in interest, you could turn that around and maybe pay a third of that, maybe $800. That extra $1,600 is something that you could use in your life, pay down that debt faster, whatever it may be. You just have to make sure you're using the HELOC correctly. I also want to emphasize that a HELOC is typically better than a cash out refinance. So if you're out there and you're in debt, you're looking to refinance, before you do that, why not look at either a HELOC or a home equity loan? We have some great videos out there on our YouTube channel. Check them out. What's the difference between a HELOC and a home equity loan? And then also the cost, the savings. How about taking care of your debt now, your payments now, but not putting your future into jeopardy? Let's dive in and look at what a home equity line is, how you could use it, and what you should watch out for. First of all, a HELOC is a home equity line of credit. So it is a mortgage on your property. That means it's going to be a lien. That means you are pledging your house for the security of this loan. So unlike credit cards where you do not have to pledge an asset like your house, you do here. So when you're getting into looking at something like this, especially to consolidate debt, you should make sure it's something that you have the ability and the want to pay it off, because it is a line of credit. The line of credit is a mortgage on your property. So you are pledging your house. It is just like any other mortgage, putting your house in jeopardy of foreclosure or anything else like that if you don't pay. Now, HELOCs can come in firsts and seconds. Most of us assume that everything is like a second mortgage, meaning you're keeping your original mortgage, your first mortgage as they call it, and you're just adding another mortgage to it, your second mortgage. But if you own your property free and clear, or you don't owe that much in your house and you just want to move it into one mortgage, you can use a HELOC as a first mortgage. They come in first and second. There's not a lot of difference in pricing between a first and a second, but you could get more money typically if you're in first position than in second position. So the biggest difference between a home equity line of credit and a home equity loan is the home equity line of credit works very similar, has the same characteristics in some sense like a credit card. And what I mean by that is you get an available line of credit when you close, when you apply for it, whatever, you get a certain amount. So let's just say it's $50,000. You're approved for a HELOC for $50,000. Now that HELOC, that $50,000 is going to work very similar to a credit card during what they call the draw period. We'll get into that in a second. For $50,000, let's just say you have that, and either at closing or shortly after or sometime during your draw period, you take out $10,000. So you have available credit of $50,000, you take out $10,000. That means you still have $40,000 available, meaning you could still withdraw up to another $40,000 as long as your accumulative, all the money that you've taken out of the HELOC does not total more than your available credit. Very similar to a credit card in that you have a maximum available limit and you can only go up to that limit. And that's where credit cards and HELOCs are very similar. There's a line of credit, you can pay it down, you can pay it off, reuse it, and you could go up to the limits as long as you're paying down, making your payments, and keeping it current. Now here's another thing I said is during the draw period. Unlike a credit card where the credit card operates the same way all the way through from when you take it out to when you actually finally close it or pay it off. A HELOC does not work that way. It has a draw period. And what this draw period is, and it's typically 10 years. So 10 years from when you start to when the draw period ends. And during that draw period, that's where it works similar to the credit card. You have available credit and you could use it, pay it down, reuse it, recycle that money over and over. But at the end of the draw period, at the end of the 10 years, it's going to stop allowing you to take money out. It's going to actually become a fixed payment, an amortized loan that's going to require you to pay it off. Now, don't worry. HELOCs are so much easier than refinancing. If you get to the end of the 10 years or even 5 years or whatever, and you want to refinance it into a new HELOC and start that 10-year period over, you could always do that. You don't always have to get into the pay down period, but just remember HELOCs, similar to credit cards in that you could use the credit over and over, the available amount over and over, but it does have a certain period where it stops working like the credit card as far as reusing the line of credit. Now let's look at the payments for a HELOC. HELOC payments are interest only during the draw periods. Unlike credit cards, which require interest plus you're looking at some pay down, usually 1% on the credit cards, they require you to pay down. On a HELOC during the draw period, it is interest only. So you only have to pay the minimum, which is interest only. But just like any other debt, credit, what it's out there, you could always pay more than the minimum payment. The payment is only calculated on the amount that's outstanding. In our example, we had a $50,000 line of credit, we had $10,000 outstanding, and we had $40,000 still available. So when they calculate your payment for that period, that month, they're only going to calculate your payment based on what is outstanding. In this case, we took out $10,000. They're going to, meaning the banks, the credit unions, are going to base your payment on the amount that's outstanding, the $10,000. And what that looks like, here's an example right here. We have an outstanding amount of $10,000. Let's just say our interest rate is 8%. So what you do to get a general payment, and each payment every month is going to be a little different because it's based on the number of months in a year, just like credit cards. In this case, if there's 31 or 28 or 30 days, it just depends on your cycle. You could get a very good estimate like this. So $10,000, 8% interest, 10,000 times 8% is your yearly interest cost. So if you have $10,000 out, it's an 8% interest rate. You're going to pay about $67 per month, give or take $3 or $4, depending on how many days are in that cycle, that period. The big thing to remember with payments on HELOCs, you're only paying on the outstanding balance. Your minimum payment is interest only. So you can see the power here compared to credit cards. Look at a couple of our other videos. It shows you comparing a credit card to either a personal line or a HELOC. And you could see here that you're going to pay a lot less, because if this was a credit card, you'd be paying 3 times that just in interest. That's the kind of money that we need to put back into your life. You can enjoy it and have some fun. So now let's look at the pluses and minuses of a HELOC compared to a credit card. Number one, the rates are going to be lower on a HELOC. They're both variable, but the margin is higher on a credit card than it is on a HELOC, depending on where your credit and all that stuff is, what your rate would be. Number two, the benefit of a HELOC is you don't have to go through a whole full refinance just to get your payments down, and it puts you in a better position as far as the amount you're going to pay over the long term over a refinance. Typically with a credit union, a good bank, you're going to be paying less than $400 in closing costs for a HELOC. With a refinance, if you have a $300,000 or $400,000 property, you're going to expect to pay anywhere between $6,000 and $12,000 just in closing costs. If you do the numbers, you're going to find that a HELOC typically almost always is better than a refinance, especially when your rates on your mortgage are lower than 4%. The other benefit of the HELOC over especially a refinance is available funds. You could get those funds and get to them whenever you need. If you have something come up, if you have a school bill to pay, if you need some home remodeling, or you're taking a vacation, whatever it may be, this is a great tool to use to manage that cash flow. The other positive compared to credit cards is you could go and actually get cash out. So if you're paying a contractor, if you're paying someone who needs cash, you just can move the money from your HELOC over to your bank account and pay them with a check, with Venmo, whatever it may be that you typically do with payments coming out of your account. And lastly, the flexible payments. If you feel like you have some extra money, you could pay a little extra. If you only could do interest only, you could pay interest only. Maybe take a vacation, have some fun, and then come back and for a month or two, just pay the interest only, and then go back to paying more on the HELOC just to get that debt down. I mean, our goal here is to get you in the best debt, but also sooner or later get you out of debt. So the negatives with a HELOC of number one is you're putting your property up. It is a mortgage against your property, a lien. So you are pledging your house. This is something that you have to think about. If your whole goal here is to get out of some of the debt, HELOC is probably not the best way to go. Keep with the unsecured stuff. If you ever are thinking or have to go down the path of a bankruptcy or anything else like that. Number 2 and 3 were also positives, but they can be negatives. Number 2, it is variable. So if you're looking at this compared to refinancing and getting cash out and just doing a fixed rate, A HELOC is probably not as good as maybe just a home equity loan. A HELOC is more like a credit card, and a home equity loan, a HEL, is more like a car loan where you have a certain amount, you take that out, your payments never change, and you know when it's paid off. And 3, ease of access. So sometimes it's not great to be able to just go to the bank, move money, have some fun, take money out, which is putting more money onto your mortgage, into your life. So sometimes the ease of access for the wrong people is not a good thing. So what are the qualifications? First of all, the higher the credit score, the easier it's going to get, and the less qualifications they're going to probably ask for. If you have a 680 compared to a 780, the 780 is probably going to get a higher loan to value, meaning more money available, and they're going to get a better interest rate on the HELOC also. So make sure you're taking care of your credit. They're also going to look at your income. You know, do you qualify? Do you have enough money to make these payments? What are you using the money for? You know, is it debt consolidation? Is it adding to your house? Especially if you're doing home improvements. Lenders love when you're doing home improvements because you're adding to the value of your property, which means that their loan is more secure. It also depends on your loan to value or combined loan to value with your first mortgage if you have a first mortgage. So the higher the loan to value, which means you owe more against your property compared to what it's worth. So if your first and second is like 90% of your value, compared if your first and second is only 80% of your value, the lower the risk to the lender, the better the rates, the more options you're going to have to qualify to get different banks competing over what they're going to charge you, not only in the rate, but in the costs. So we have some other videos out there, but what are the rates? What are the costs? It really depends on where you go and who you're working with and who has the best deals out there. Typically, what you're going to find are the local and national credit unions have the best rates and closing costs. It's not uncommon for a lot of these credit unions to charge you maybe $75 or $100 or waive that if you keep the HELOC for a couple of years. And like I said, compare that to, you know, going out and refinancing your house. It's not even in the same ballpark. And don't just go by the teaser rate. Go by the rates that are going to affect you over the next 10 to 20 years. We have a great video about that on YouTube. Most national banks or mortgage brokers are, you know, they're in it to make a little bit more money, so they're going to charge a little bit more. Next, even though 80% plus of the HELOCs out there are variable, there are some credit unions, small banks that actually have a fixed rate for, you know, sometimes it's 2 to 3 years of that 10-year draw period. But look and see what you could do out there for fixed rates too on the HELOC. And quickly, what you're looking for when you're looking at a variable rate is the margin. They call it a margin, I call it a profit margin. All of these HELOCs are based on what they call a prime rate. It's the bank's prime rate. And what they do is they have a margin and they add it to the prime rate. So you'll go to a bank and they'll have prime plus a margin of 0, where you'll go to another bank and they'll have prime plus a margin of 4. So you want to make sure you're finding the best deal for you, which is the lowest margin and maybe even a negative margin, which means instead of prime plus something is prime minus, meaning they're giving you even a better rate. So when you're shopping, make sure you get the best deal for you. Check out our website. We have a great download where you could actually go through and it's a little shopping guide on when you're talking to people, who has the best margin, who has the best rates. It's, you know, taking an hour or two of your time to shop around 3 or 4 places. That could save you tens of thousands of dollars over the life of your loan that could be put back into your life. Comment below if you have any questions, if you want us to go over anything else on HELOCs or even home equity loans. HELOC is a great tool as long as you use it as a tool and be responsible. Remember to check out smartwithdebt.com. There's a lot of downloads there that'll help you not only in HELOCs, but in 0% cards or how to refinance, all those kind of things. Making sure you're getting into good, healthy debt, the debt that puts you farther ahead. You know, save $2,000, $5,000, $10,000 a year, just not overpaying the banks. Put it back in your life, enjoy it, and we'll catch you on the next video.